Hello to everyone. My name is Antonio Ciotola from project Trade Systec. You can visit our website trade-systec.net where you can find many information related to the trading systems, automatic trading. We have a blog where we publish frequently many information regarding the trading, genetic trading, and options as well. In this short video, we are going to describe the definitions of options, the basic concept related to the options, and what is really important to understand in order to start to trade options. It might be when you start to hear about the options, it might be a bit complicated and theoretical in the early stage. But after a while, all these theoretical concepts, they become to be part of your background and you don't need to think about of that anymore. It's like when you start to drive a car. You know, you learn many theoretical concepts like how the engine works, what the shift is, and so on. But once you are in the car and you are starting to driving, you don't think about anymore about these informations. But it's really important to understand what are the basic ideas behind the options. Okay, what the options are then? Options are a derivatives instruments applied to a certain underlying asset such as stock, indexes, ETF. So it's not like a linear instrument such as stock shares or forex, but it's a not linear instrument. There are two types of options, put and call. They are themselves, they are the contract. Options are contracts that when purchased, they allow to exercise the right, but not the obligation, to buy in case of call or sell in case of put the underlying security at a certain price called strike within a certain date called expiration date. Alright, so let's start with a very simple example. I decide to buy a call with a strike 10 and the expiration month is the front month. Please bear in mind that the expiration date is always the third Friday of each month. Today is 30 July 2015 and let's say I'm buying coal with the expiration month, front month, which in this case is August, and the expiration date for August is 21st August. Meaning, so if the strike is, for example, 20, it means that within the expiration date, which is 21st of August, starting from today, 30 July, I have the right to buy underlying within the expiration date to the strike price. While if I buy a put, I have the right to sell the same security. So assuming the strike and the expiration date as the same concept. The opposite is the selling of options. So who sell the options may be obliged. So the buyer has a right. The seller may have an obligation. So who sold the options may be obliged to buy the underlying. By whom? By the put seller in this case. Or to sell the underlying to the call seller in this case. Against with the price called strike and within the expiration date. So it's like an agreement. I'm buying a call, you are selling to me this call. We implicitly agree on a certain duty between us. I have, as buyer, I have the right to buy underlying, and you have the obligation to sell me the underlying within a certain expiration, if I decide to exercise this right within the expiration date. Okay, let's have a look to the graph and to some example, because the things then start to become very clear. Let's start from what is more familiar to us, such as the underline. On 21st of July, I decide to purchase 100 shares INTC. Price is $35, meaning I'm risking $3,500. Let's say in about 1 month, INTC goes up to 45. Wow, fantastic. Then I earn $1,000. Why, if in the same period INTC slow down to 25, then I lose $1,000. It's the typical linear profit and loss graph. Here I have the profit, loss, and on the horizontal line, the underlying price. If price goes up, I'm making profit. If the price goes down, I'm losing money. That's typical of the linear instrument. Let's move to the option then. So bear in mind, I might lose $1,000. Now, let's move to the call. Instead of buying underlying, I decide to buy a call instead. Meaning, in this case, I have the right to purchase underlying to a fixed price. Let's say I decide to buy a call which strikes $35 within the expiration date, which is the 22nd August. In this example, I decided to buy a call with the expiration month, the front month. To do that, I have to pay a premium, which might be $2 in this case. Remember, one contract leads 100 shares, meaning the total risk for me is 2 times 100. So in total, I'm risking only $200. That's my maximum loss, compared to the linear case where the maximum loss can be 1,000, maybe even more. That's already the beauty of the options when you compare to the underlying. So in principle, as I could in principle exercise my rights to buy INTC at $35 and reselling to a higher price such as $50, then if let's say on 22nd the underlying clings to 45, then I earning $800, 1,000 minus 200, which is the premium I have to pay. While in the linear case, the profit would be 1,000. In this case, the profit would be a little bit less, 800. But if the underlying slows down to 25, in the linear case, I would lose $1,000. In the call case, then I would lose only $200. That's already a very good advantage of the options. Okay, that's the case where we are long over the underlying. Let's concentrate now to the case when I'm short over the underlying. When I'm short, so I'm selling underlying, I'm becoming, as you know, I'm becoming bearish. I might decide, instead of going short over the underlying, I might decide to buy a put. In this case, I have the right to sell the underlying to a fixed price. Let's say 35 is the strike that I'm choosing within the expiration date. Once again, I'm choosing front month. And maybe I have to pay a premium such as $1.19, which means the invested capital is $190. This would be, again, my maximum loss. Now, when the underlying tumbles, when purchasing put, I might buy 100 shares for a few dollars to exercise my right to resell to, let's say, $35. And I would get, once again, this profit and loss graph. So again, in case the underlying is going down, I'm earning exactly as in the case of the underlying of the linear instrument. But when you go short over the underlying, if the market moves against you, and let's say it starts to goes up, 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 up again, theoretically, your loss, there is no limit to your loss. It can be worse and worse and worse. In the option case, once again, my loss has a limit, and this limit is the premium price which I have paid. In this example is just, it's less than $200. So you see the great advantage of the option compared to the linear instruments. And we are not touching other components such as time, volatility, which is also very important. But let's focus on the comparison between the linear case and the non-linear case. All right. As for the linear instruments, even the options can be solved. You can intuitively realize that the profit and loss graph for the options that are sold is in a sort specular to the case when we buy the options. So if I look at, let's have a look to the buy put. This is the profit and loss graph when I decide to buy a put. You can imagine then when I decide to sell a put, this graph is exactly the specular. It's like that. So in this case, I'm becoming bullish or almost bullish. So if, let's say, I sell a put with strike 35, as long as, let's say that the underlying is 37, I can accept that the market moves against me till 36, 35, maybe even 34. You see here, this is the break-even point where the profit and loss is 0. And then if the underline starts to move up, then I can finally get my premium. Because as you know, as we said at the beginning, when I sell an option, I'm paid and I get a premium. Similar thing when I decide to sell a call, and the profit and loss graph becomes specular compared to the graph of buying a call, where it is, yeah, this one. So when I sell, I get exactly the specular one. We don't like a lot the graph for selling a call, because you see, even in this case, when the underlying starts to move against me, then the loss can increase more and more. But you don't need to be scared about that, because as we show you in next videos, we can introduce a strategy where this loss can be cut. So we're gonna explain later on. All right. In few words, you need to keep in mind that options, just to give you a very intuitive idea of what the options are something similar to the assurance. Summarized, we can say that the option seller is like the insurer, while the option purchase is like the insured. And in fact, as you know, in case of insurance contract, when you pay a premium, you get the right to be reimbursed in case of bad events such as fire, car crash, and so on. Instead, the insurer has the obligation to refund the insured in case of accident. And in some cases, even the insurer tries to cover himself by buying an insurer. But this is once again a composition of strategy and spread It's something a bit more complicated that we're going to explain in another video. Alright, so we touched the definition of expiration date, strike. Expiration date is the date by which the option purchasers can exercise either right to buy the underlying if she has bought a call, or to sell the underlying if she bought a put to a fixed price which is established, agreed at the opening of the contract. This price is called strike. Remember, the expiration date is always the third Friday of each month. Whatever is the month I decide to use for my option. Let's move to another important concept related to the option, which is the moneyness. Moneyness, in a sense, is the value of my option. The option that I'm buying might have a very big value, low value, or very low value. In short, moneyness is the comparison between the underlying position and the strike value. Let's start with the ATM definition. ATM stands for at the money. That happens when the strike of my option is equal or very close by the underlying price. In the money, ITM, that happens when the option exercise is profitable for me compared to the current underlying price. This happens when the underlying exceeds the strike in case of buying a call, or if the underlying is below the strike in case of buying a put. Don't be scared. We move very quickly to an example, and with this example it's easy to understand. And finally, the OTM. OTM, out of money, it's when the option exercise is not profitable compared to the underlying price. Alright, let's have an example here. Apple. Today Apple is quoted to 100, well, maybe it's much more, but okay, just let's use this number, $150 in June. Today, with this quotation, I decide to buy an Apple with the expiration month July and the strike price is 150. Whether it's a call or put, in this case, I am having an ATM options. ATM is because the strike is very close to the quotation of the underlying. For that, I might pay a cost of $3. We say every option is leading 100 shares, then my premium, the premium that I have to pay is $300. Now, let's decide instead to buy a call with strike 140. In this case, the underlying is higher than the strike, and according to the definition then, my call is in the money. Why? For the put case, when the underlying is below the strike, once again it's an ITM. You know, it's always in a sort of specularity between the two options. In few words, when you buy an ITM option, you can make profit by exercising this option. That's in really few words. That's the intuitive idea behind that. OTM is the opposite, out of money. You have an OTM option in case of call when the underlying is below the strike for the call case. For the put case, the option is OTM when the underlying is over the strike. To be even more clear, we can summarize what we are saying onto these two very simple examples. You see here I'm plotting the call and the put. When I buy a call, when I buy a put, this is the strike. This point here is called break-even point. Is the point where I don't make profit and I don't make loss. Now, in case I buy a call, when I buy the call with strike exactly equal to the strike, when I buy a call with the strike exactly equal to the price of the underlying, then my option is an ATM at the money. Why? If the underlying price, if the strike is below the underlying price, then my call is ETM. The strike is below the underlying price. And if the strike is over the underlying price, then my call is the OTM, out of money. The put case is exactly the opposite. Again, if the strike is equal to the underlying price, then I have an ATM. Why? If the price is below the strike, it's an ETM. If the price is over the strike, it's an OTM. So in short, when my option is in the money, it means that if I exercise this option, then I'm making profit. That's why it's called in the money. Alright, I'm gonna leave you with these final greetings. I want to thank you for watching this video. Once again, I invite you to visit our website, and if you have questions, observation, don't hesitate to use our contact form and to send email to us. We are happy to assist you. Thank you, and hopefully to see you again in the next videos. Bye bye.